This is the summary created from the video, Week 3, Lecture 14. The video summarizes a projection case study, guiding viewers through reading the case, analyzing financial data, calculating costs and prices, creating optimistic and pessimistic projections, and reaching a final conclusion. In this case study, we explore the application of marginal costing for data projections in the cement industry. The focus is on using the previous year's information to project data for the upcoming year, assisting management in making informed decisions. This exercise builds upon the theme of data projection from past sessions, emphasizing the importance of marginal costing knowledge. The case study is set in India, the world's second-largest cement producer after China. With various infrastructure projects expected to boost cement sales, the industry anticipates a sales growth rate of 10 to 15% for 2015. The task at hand is to create both optimistic and pessimistic projections for March 2015 using data from 2014. To create accurate projections, several key factors are considered. The projected growth rate for sales ranges from 10% in the pessimistic scenario to 15% in the optimistic one. Selling prices are expected to increase by 10%, while employee costs are growing at 15% annually. Operating costs, excluding employee expenses, are anticipated to grow by 10 to 12%. Management aims for a 20% margin on the cost of sales for cement pricing. The financial data is broken down into various components for analysis. Raw material costs are split into variable and fixed portions, as are power costs and employee expenses. Selling and administrative costs are divided between selling and admin functions with varying degrees of variability. Depreciation costs remain constant, and the total cost of sales is calculated to determine the operating profit. To determine the cost per unit, the total cost of sales is divided by the volume of cement sold. This calculation assumes uniform sales across all cement varieties and includes depreciation but excludes other income and interest. The resulting figure provides a baseline for pricing decisions and further projections. Using the cost per unit, both normal and concessional selling prices are calculated. The normal selling price includes a 20% margin on cost, while the concessional price is based on variable cost plus a 20% profit margin. These calculations provide important benchmarks for pricing strategies in different market conditions. Projections for optimistic and pessimistic scenarios are then developed. Raw material costs, fixed costs, power and fuel costs, and employee expenses are adjusted based on expected growth rates and market conditions. The operating profit is calculated for both scenarios, providing a range of potential outcomes for the company. Final calculations include tax considerations, with a 15% tax rate applied to both optimistic and pessimistic scenarios. Sales increases of 15% and 10% are used for the optimistic and pessimistic cases, respectively. Sale prices and concessional prices are calculated based on costs and desired profit margins, offering a comprehensive view of potential financial outcomes. The case study concludes by highlighting key takeaways. Data projections prove invaluable for management decision-making, especially in the context of expected infrastructure growth in India. The varying growth rates for different cost components significantly impact profit projections. The study also notes that the assumption of uniform costs across all products may not reflect reality and emphasizes the importance of concessional pricing and tax considerations in final profit projections. Please stay tuned for more summary videos.